Hi everyone, welcome to TNPSC AO classes by Tarvos, and today we are going to see previous year questions of Agricultural Economics from the question paper 2021. And today we'll practice few questions from Production Economics, Marketing, and also from Microeconomics. A few questions like demand, cross elasticity of demand, and these things. So with this, we'll move on to the questions. So the first question is question number 11. The following is not the characteristics of land. This is from production economics. So try to answer which is not the characteristics of land. So option A is free gift of nature, B permanent resource, C distinct characteristic features from location to location, and D supply is elastic. So the correct option will be option D, supply is inelastic. Okay. So if you can see here, yeah, it is a free gift of nature. It is not a man-made resource. It is not a man-made factor of production. So we can like distinguish the factors of production into man-made and the free gift of nature. So under free gift of nature, you will get land and labor. Man-made, you will get capital and management or organization. Okay. So second, it is permanent resource. Yeah, it is a permanent resource and it varies from location to location. Its characteristic varies based on soil, based on topography, based on geographical location, based on many things. The characteristics of a land will vary, and the supply is inelastic. Okay, we'll see the explanation in the next slide. If you see the core properties of land, it is perfectly inelastic. So, for example, if the demand for rice is getting increased, okay, demand for rice is getting increased. So, the farmers are demanding more land for increasing the production. To increase the production, they are demanding more land. Is it possible to increase the land area? No, okay, it is technically not possible to increase the land area. What a researcher or what a government can do is they can go for giving a high yielding variety or subsidies or something like that to increase the productivity. Okay, we can only increase the productivity, but no, we cannot increase the supply of land to increase the production of paddy, right? So that is the concept. Geographical land area cannot be expanded. It will be always fixed, and the elasticity of supply is zero. That is perfectly inelastic. And it is a free gift of nature, and it has zero cost of production for society. Okay. The production of land, we need not to give anything for that. Okay. And next, if you see the economic feature, it is permanent one and it is indestructible. No one can destroy the land. And it is given by David Ricardo. That is, the David Ricardo told that the land is permanent and it is indestructible. That is why we are paying the rent for the land. And it is heterogeneous. That is, the characteristics of land vary based on the fertility and location, and it is immobile. You cannot move the land from one place to another. These are the characteristics of land. Okay. So we'll move on to the next question. So the question is the slope of isoquant indicates. So you can see this question in 2018 question paper also. So the options are marginal rate of product substitution, marginal rate of technical substitution, elasticity of substitution, elasticity of supply. What is the slope of isoquant? So the correct option will be option B. It is marginal rate of technical substitution. So before knowing the slope, you have to know what is isoquant. So what is isoquant? Iso means same, quant means quantity, output. Okay, it is a line or a curve that represents all possible combinations of two inputs, x1 and x2, all possible combinations of two inputs that yield same output. Okay, combination of two inputs that yield same output. It is also called as equal quantity, equal output curve. It can be called in various ways. Okay, and the slope of this isoquant is what we call it as marginal rate of technical substitution, MRTS. Okay. And what is MRTS? It is the slope for production possibility curve. You can expect this question also. MRTS is the slope of production possibility curve. And here is the explanation. So, Isoquant connects input combinations yielding constant total output. Our Y will be constant, but our input combinations will be different. Say, for example, urea and DAP. So, we can make various combinations, but our output should be constant. That is the concept over here. And the slope is marginal rate of technical substitution, which can be represented as change in X2 by change in X1, which can also be represented as the ratio of marginal physical product of X1 divided by marginal physical product of X2. Okay. And this is a very lengthy derivation. You can refer to any books. I can't cover it in a single video. This is just PYQs and their explanations. Okay. So the memory trick is that for inputs, that is for Isoquant, it is marginal rate of technical substitution. For output, that is production possibility curve, it is marginal rate of product substitution. Okay, remember it. So here you will have that change in Y2 divided by change in Y1. That is the only difference between MRTS and MRTS. And you can also expect question of properties of Isoquant. So Isoquant will be always downward sloping. A set of Isoquant curve will be Isoquant map. We call a set of Isoquant curve as Isoquant map, and slope of Isoquant is marginal rate of technical substitution. They do not intersect. The Isoquant which is right will have a higher combination, and all these are properties of Isoquant. This is our next question. At break-even point, the profit to the farmer is negative, option B 0, option C positive, option D cannot be calculated. So at break-even point, what will be the profit of the farm? So the correct option is option B 0. What is a break-even point? It is a point where total revenue curve intersects with the total cost curve, where the total revenue is equal to total cost and the farmer is neither having profit nor having the loss. Okay, it is a point until when the production should be carried out. After this point, after break-even point, the farmer will start seeing the profit or start gaining the profit. Till that point, he will be in the loss. That is the concept. Here is the explanation. So break-even point is a point where total revenue is equal to total cost. If you see, the total revenue curve will be this one and total cost curve will be this one. Okay. And this point we call it as break-even point. Okay. And this point there is no profit. Total revenue minus total cost will be 0. The net profit of the farmer will be 0. And in 2018 question paper, they gave numerical sum from this topic. So they asked us to find the break-even point. Though the formula will be fixed cost divided by variable cost per unit minus selling price per unit. This will be the formula for calculating the break-even point. And our next question is, which of the following is a or irrational zone of production? Okay, the same question we had seen in 2018 question paper also. So whether it is zone 1 or zone 2, zone 3 or zone 1 and 3, which is the irrational zone? So this topic is from production economics, the product factor product relationship. So there are three relationships. You can expect question from all three relationships. For example, the Isoquant question is from factor relationship. This question is from factor product relationship. So which is the irrational zone? The correct option is option D. It is zone 1 and zone 3. Okay. If you see, we will have three curves, TPP, and then it is MPP, and then APP. Okay, total physical product, marginal physical product, and average physical product. So this zone is what we call it as rational zone. This zone is the rational zone. Except this zone, the zone 1 and zone 3 will be irrational zone. If the farmer wants to alter his production format, or he has to, if he is thinking of adding more inputs, he can do only in the stage 2, because only in the stage 2 he will incur the profit and not in the stage 1 and stage 3. Here comes the explanation. Stage 1 and 3 we consider as irrational because in stage 1 elasticity of production is more, which means that we are underutilizing our fixed resources. And in stage 3 we see negative returns because MPP is less than 0 and even total physical product will be declining in this stage. Stage 2 is considered as rational because profit maximization occurs in this zone. If farmer is deciding in this zone, he will be sure about his profit, and it starts where MPP is equal to APP and it ends where MPP is equal to 0 and TPP is maximum. Okay, so please make sure you watch the entire videos, that is the concept clearance videos. This or just to make you confident on the topics, important topics, not the concept understanding. Okay. And next question is question 15. This is also from production economics. Which method of depreciation is suitable for livestock assets? There are various methods of depreciation. In that, they are asking which method is for livestock asset. So, straight line method, B is diminishing balance method, C is annual revaluation method, and D is compound interest method. So the correct option will be option C, annual revaluation method. Okay, these are types. Okay, the straight line method is the one of the easiest method for calculating the depreciation. So it is original cost minus salvage value divided by useful life. And in case of diminishing balance method, the value of the asset will be declining year by year. There you will calculate by differentiating the purchase cost and the accumulated depreciation and multiply it by the rate of depreciation. And last one is sum of year digits method. In sum of year digits method, what we do is we go for fraction. So each year we give different fraction, and the fraction multiplied by amount to be depreciated, you will get the depreciation amount. And for livestock, we exclusively use this annual revaluation method because each year the value of the livestock varies. So if you see the explanation here, the asset revalued at market price annually. Each year the market price varies. In the initial years, there will be appreciation, means the livestock value goes on increasing. But after a maturity period of the livestock, because of the biological rationale, the value of the livestock will be declining. As it ages beyond the growth phase, its value will be declining. That is why we go for annual revaluation method. The reason is because of the biological life cycle. Our next question is question 16, and this is from microeconomics part. If the price of coffee raises from 45 to 55, the consumer demand for tea increases from 600 to 800. What is the cross elasticity of demand? So, types of demand, there are three types: price elasticity. Sorry, types of elasticity of demand. There are three types: price elasticity of demand, income elasticity of demand, and then cross elasticity of demand. So what price elasticity of demand defines is that proportionate change in quantity demanded due to proportionate change in the price. Okay. And for income, it is proportionate change in the quantity demanded due to proportionate change in the income. And in case of cross elasticity of demand, it is proportionate change in the quantity demanded of X1 due to the price proportionate change in the price of X2. So what impact will be on the quantity demanded of X1 due to the change in the price of the X2? Okay, here they are asking for cross elasticity of demand. So try to calculate it. So the correct answer is option A. We'll see the explanation here. So elasticity, cross elasticity of demand X for Y is equal to percentage change. In this formula I have already said. Okay. So it is nothing but change in quantity of T divided by quantity of T, the whole divided by change in price of the T divided by price of the T. So what they have said, the quantity of T, initial quantity was 600 and the change in quantity was declined to 400. So it is 200. Okay. And the same way, the price is, initial price is 45. It has increased to 55. Then the change in price will be 10. So if you are dividing initial 200 divided by, sorry, the change in quantity 200 divided by initial quantity 600 multiplied by 100 is 33.33 percentage. And the change in price 10 divided by initial price 45 multiplied by 100 is 22.22. And if you are dividing it, because the formula is percentage change in quantity demanded divided by percentage change in price, if you are dividing it, you will get plus 1.5. If the value is in plus, which means that they are perfect substitutes. They are substitutes, sorry, they are substitute goods. Okay, perfect substitute is you should get 1. Then which means that it is perfect substitutes. Okay, for each quantity of tea, we will substitute coffee. So next question, allocative efficiency is also called as. So this is also from production economics. The options are technical efficiency, pricing efficiency, economic efficiency, operational efficiency. So efficiency is nothing but it is nothing but the ratio of output by input. The correct option is option B, pricing efficiency. We'll see the explanation. So there are two types of efficiency. One is pricing or allocative efficiency and other is technical efficiency. So technical efficiency is nothing but maximizing the output with a given input. With a given input, how can we maximize the output is what we call it as technical efficiency. Pricing efficiency, which is also called as allocative efficiency, because how well we can allocate the inputs so that we can maintain the optimal price proportion. That is the concept. That is why we call it as pricing or allocative efficiency. It can be attained where the marginal value of the product is equal to marginal fixed cost. Marginal value of a product is nothing but marginal physical product change in the output multiplied by the price of output P of Y, and marginal fixed cost is unit price of input P of X. Please bear with my handwriting. In computer, I can only write in this way. Okay. And so economic efficiency is nothing but the technical efficiency multiplied by allocative efficiency. This is what we call it as economic efficiency. So efficiency is nothing but output by input. Okay. So our next question is from marketing. Question number 18. The difference between the price paid by the consumer and price received by the farmer is called as. What is the difference between consumer price and the producer price? Option A, marketing margin. Option B, price spread. Option C, marketing cost. And option D, producer surplus. So the correct option will be option B, price spread. Price spread is the difference between consumer price and producer price. So we'll see the explanation of other things also, which is also important. You can expect from this concepts also. Marketing margin. Marketing margin is nothing but the difference between the income gained by each market intermediaries. For example, producer is selling to wholesaler. So the difference between producer price and wholesale price, in what margin he is purchasing from the producer is called as marketing margin. Same thing when wholesaler sell to retailer, in what margin retailer purchased from wholesaler, this is called marketing margin. The difference in price between each marketing intermediaries is called as marketing margin. Marketing cost is the total cost incurred in moving the goods from the producer till the consumer. What are the total cost incurred comes under marketing cost. So producer surplus is nothing but the surplus quantity available in the hands of the producer after his consumption needs. After his needs, what surplus amount is available for the consumer is called as producer surplus. And price spread, as we discussed already, it is the difference between consumer price and the producer price. So price spread includes total marketing cost plus net marketing margins of the intermediaries. All this will be included in the price spread. So lower the price spread, higher the marketing efficiency, which means that the farmer is having larger share in the entire marketing cost. So next question is question 19. A market in which purchase and sale takes place at a time t in the present time, but physical change in the commodity, physical exchange of the commodity takes place on a specified future date t plus 1. Options are spot market, forward market, secular market, primary market. So the correct option will be option B, forward market. Okay. So spot market is nothing but it is a market where the exchange of commodity takes place immediately after a purchase or sale. Okay. On spot, the exchange will be done. But in forward market, the exchange will be done on some future data. Secular market is nothing but the market which are permanent in nature. Example, market of machineries. For long duration commodities, we use this secular market. Okay. For non-perishable commodities usually. And then is primary market. So primary market comes under the markets based on the location. So it is a primary place where the first major transaction takes place. The village market, rural primary market, all these things. Okay. So here the explanation, spot market is cash market. The delivery is done immediately after the purchase. But in forward market, it is future market. Delivery takes place on the takes place on specified future date of t plus 1. Okay. This is used for hedging. Hedging is nothing but to secure the price or to lock in the price will go for hedging. You should also look for the difference between hedging and speculation. Those things are also very important. Okay. So next question is question 20. Agricultural markets were classified into regulated markets and unregulated markets on the basis of what? Options are volume of business, time span, public intervention, degree of competition. So the correct option will be option C, public intervention. Okay, public intervention is nothing but government rules and regulations. Government coming in middle of the marketing process. Because of that, there are two types. If government is intervening, we call it as regulated market. If government doesn't intervene in the marketing process, then we call it as unregulated markets. So in regulated market, wholesaler, retailer, the interventions of middlemen will be reduced. And based on volume of business, you can classify as wholesale market and retail market. Based on time span, you can classify it as short period market, long period market, secular market. And based on degree of competition, perfect market, imperfect market, and again imperfect market, monopoly, duopoly, oligopoly, monopolistic, and all these things comes under degree of competition. This is the explanation. So regulated market comes under the statutory APMC Act, Agricultural Produce Marketing Committee Act. So the marketing committee will be there for governing the marketing process, and it will eliminate the malpractices, and mostly they go for open action. And in unregulated markets, it is free. It doesn't come under any statutory rules of governments, and there will be more number of middlemen, and marketing cost will also be more in case of unregulated market. Okay. So that's it. Thank you for watching the video. Hope you liked it. Hope your concepts are clear. And I'm mentioning one more time, this is not for your deep understanding on the subject. This is just to know the important topics from where you can expect a question. We have a unit-wise videos uploaded in the page, so please look into it and make use of it. And before exam, just watch this video in 2x and try answering the questions in the gap of 5 seconds which I have given after reading the question. And thank you for watching once again, and we'll see you in the next video.